I think we're ready to start. David, over to you.
Okay, thank you, Tony, and good morning, everyone, and welcome to Cryptos Aren't Just for Christmas, They Are for Life, Part 1. Now, this is Part 1 of a two-part series. This morning, we're going to be talking about the accounting and tax treatment of cryptos. In the second feature, which will be coming to a cinema near you in the new year, we'll be looking at the regulatory, security and auditing pieces around cryptos. And by that, we're talking about something obviously broader than cryptos themselves, the whole ecosystem, the whole blockchain system that underpins it. Why cryptos aren't for Christmas? Well, it's Christmas next week, so it seemed topical. And of course, we're all told that when we get a pet for Christmas, it is for keeps. It seemed appropriate that we're now in a situation where it's patently clear that cryptos, the blockchain and that environment are here with us to stay. Not necessarily in the form and the format that we now see them in, but certainly the genie is out of the bottle and is never going back in. Now, one of the things that puzzled me about the photograph here was why the puppy was looking so sad, because as you know, overnight, probably for us in Singapore, Bitcoin just hit an all-time high of around about 21,000 US dollars. So that could possibly be a reason for the puppy to cheer up and not worry so much about Christmas. So joined on our presentation today, looking at, as I say, the accounting and tax treatment for cryptos, we have, first of all, Chetah Hans, who is in charge of our financial reporting advisory services group here in Singapore. I will be picking up on the income tax side of things. I'm a tax partner and head of tax for the firm here in Singapore. And then we'll be followed by Jeremy O'Neill, who heads up our GST department. So let's take a look at what we're going to be talking about today, and starting by what we won't be talking about, which is explaining how blockchains work. That would take probably several days of deep discussion, and we're assuming that people have at least some sort of basic working knowledge about what blockchains are around. But what we will be talking about is the accounting for digital token transactions and the income tax and GST consequences of transactions in digital tokens. Now, what you'll notice about this talk is, of course, it is rather Singapore-centric by definition, because we are Singapore accounting and tax experts. But of course, I believe that what we're going to talk about are principles that have a much broader application internationally. Certainly when you look at accounting for digital transactions, international financial reporting statements are going to take up, you know, most of the universe in terms of relevance. On the income tax and GST sides, well, what you'll see from our discussion is that the income tax outcomes follow a certain degree of logic, and the Inland Revenue Authority have come out with some pronouncements in and around this, which seem reasonable and logical. And I would expect that reason and logic is going to be followed in other jurisdictions. GST as well, nothing illogical about the conclusions that we're going to be drawing from this. And of course, GST and VAT systems around the world are largely synonymous. So although we'll be talking about Singapore specifically, this has wider implications. So just a quick overview of the types of digital token that we're going to be talking about today, broken down into, first of all, the payment token, which essentially is a token that only has a single function, which is to act as cash or as a medium of exchange. And into that bucket, of course, goes Bitcoin and Ethereum. Utility tokens are essentially vouchers, if you like, that can be exchanged for goods and services that are going to be provided in the future by the issuer. So if you want to get Christmassy again, think about your Christmas presents, your Christmas vouchers down at Takashimaya and how they work. They're effectively a down payment or a part payment for delivery of future goods and services. And then we have the security token, which of course has evolved on the back of perhaps the utility token being dragged into a regulatory framework. And effectively the security token is one that gives access to rights over a company of business. And basically you can think about it as being either debt or equity in essence. And then of course we have the hybrid. That would be a token which has the features of more than one of the above. And of course, when we're doing this analysis, we've got to make a decision as to how those features interplay and where the token actually sits in the universe. So some of the things we're going to be talking about today and what you can do with a digital token. First of all, they can start life by being mined. Utility tokens can be issued through the initial coin offering, the ICO, which of course hit a couple of speed bumps in 2018, 2019, but still around and obviously still there issuing utility tokens. And then, as I mentioned more recently, the security token offering or the digital security offering is essentially when you're issuing something which is more like a standard equity or debt instrument. You can trade with the things, you can use it to pay for goods and services, and what we're seeing in the distributed finance arena is you can lend it out. And then there's a couple of things that happen to tokens. Specifically, you can stake them, airdrop them, and then fork them. So these are some of the things that we're going to be talking about today from both a tax and an accounting perspective. So what I'm going to do now is hand over to Chetah. And the reason we're starting with accounting is because that forms the basis of even the tax piece. And I think it's important to get a grip on the accounting. We can then draw from that what the tax consequences are going to be. Obviously, there will be differences. So I'll hand you over to Chetah to take you through the accounting. If we can hear him.
Yeah, so I was having some trouble with the audio. Can you hear me now?
Yes, can.
Yeah, right. So good morning, everyone. As David introduced, I am Chetah Hans, and I lead the financial reporting advisory services at Thornton. And as part of the accounting, while we were focusing on Singapore aspects and the SFRS in particular, it really draws the guidance from IFRS because the guidance in Singapore is quite aligned to it. At the moment, there is no specific guidance under IFRS for cryptographic assets or crypto assets. So, we really need to understand the purpose and the business model of the company for, acquiring or holding crypto assets and then kind of determine the accounting treatment. While, we will be going through some of the guidance, there has been some discussions by the International Financial Reporting Interpretations Committee. So we do have some direction from them, but there is no codified standard on cryptos as of now. Things may change in future, as these transactions and as cryptos gain more prominence and they become more stream. We hope that there will be more guidance coming in from the International Accounting Standard Board, which Singapore should adopt as they've done in the past. Right. So when we come to tokens, we're probably going to first take up the payment tokens, the likes of Bitcoins and Ethereums and all the other cryptocurrencies, as it's popularly also called. So when we look at the guidance under IFRS or SFRS, we have a bunch of standards that we can consider. So FRS 7 provides us guidance on what is cash and cash equivalent. So the recent interpretations committee meeting kind of decided that cryptocurrencies, they're not really cash and cash equivalent in nature, and the reason they decided for that was twofold. It is not as widespread as a medium of exchange as a normal currency is. And the second and the more important is that the way IFRS or SFRS defines cash and cash equivalent is that it should be subject to an insignificant loss of value. And we have seen, the tokens, the value of the tokens fluctuates quite a lot. There is a high degree of volatility. So from a peak of 1,000 US, it's come down a lot. So it went up very fast, it came down very fast. So that's one of the primary reasons it's not considered as a cash and cash equivalent under the SFRS framework. Now, the next standard, then you kind of think about it is, whether it's a financial instrument and whether we need to carry the asset at fair value through profit loss or fair value through OCI. Generally speaking, cryptocurrencies that you may mine or you may acquire through, you need to look at whether there's a contractual arrangement, because financial instruments are defined as contracts. So if there is no contractual arrangement, let's say you mine a cryptocurrency, then there is no contractual arrangement. So you can't even apply FRS 109 financial instruments. However, under certain circumstances, FRS 109 will become relevant, and those are things like ICOs or security tokens, where there might be a contractual element involved, and it may meet the definition of a financial asset or a liability, depending upon from whose perspective are you looking at. FRS 40 and FRS 16, they're quite simple. You don't consider them, even if it's a token which monetizes a physical asset like a real estate portfolio. The reason you don't consider them either an investment property or a property, plant, equipment is that cryptos by themselves do not have a physical nature. These standards apply to holdings of your physical asset. However, having said that, these can still be considered as FRS 109 if it meets some of those criteria. Now, next we come to FRS 38, intangibles. And that's where cryptos meet the definition under the current framework, because it's recognized, it's separate. It can be transacted, it can be sold, or it can be leveraged. It can be, you can raise even funds against by pledging them if the banks permit, obviously. So it meets the definition of an intangible under the current SFRS framework. So yes, if you're holding an crypto asset, more particularly the cryptocurrencies, chances are it'll probably end up being an intangible asset. Now, I know it is quite counterintuitive to think of cryptos as intangibles, because the way we are used to dealing with intangible is that intangible remains in the books at a historical cost and is amortized, whereas in the real world, cryptos, you'll see a lot of volatility. So I'll explain how that issue can be overcome. But as I said earlier, there is no guidance right now which is specific to cryptos, and we hope as these things become more mainstream, there's probably going to be maybe a dedicated accounting standard or some guidance from the international accounting standard boards on how to account for some of these cryptos assets. And the last standard that we need to consider is inventories, and in certain circumstances it can become inventories. So I'll probably move on to the next slide, which will explain how you analyze or which accounting standard you would probably need to deal with. So when you have when you are holding a payment token like a Bitcoin, Ethereum, Litecoin, stablecoin, etc. So the first thing that you would really need to look at is your business model and your purpose So if you intend to hold it for trading, and when I say trading, you're dealing like a commodity broker or a dealer, where you do buy sell transactions, you do intraday, you do a lot of things to make money from the arbitrage in the market, right? You intend to profit from the price movements. Then you can apply IFRS 2 or FRS 2. What the standard says is that if you're a dealer broker, and while this guidance is specifically for commodity brokers and dealers, one can apply it by analogy, that this is also kind of a commodity. So you can apply it by analogy and saying that I am a dealer broker and I can then carry my holdings of cryptos at fair value less cost to sell. What this really means is that each reporting date you will do a fair valuation exercise. Essentially, you will get the fair value from the exchanges, and you will record a gain or loss in the P&L. One word of caution over here is that some of the more popular cryptocurrencies have a fairly correct fair values available because they are traded, the liquidity levels are high, but that might not be the case for all cryptocurrencies. So you'll really need to look at whether the fair value that you're getting at the reporting date, whether it reflects the most recent price, or it's a relatively stale price. So you may need to, at that point, also need to maybe consider engaging a valuation professional if required. The second business model could be, other than held for trading, that you have it, you're holding it for some other purpose. You're holding it for capital appreciation, which means you intend to hold it for long term. You will sell it, but you don't want to do like a spot trade or a daily trading or an intraday trade. So in those circumstances, you land up in the FRS 38 model. So what FRS 38 says is that in FRS 38, you have two options. You either adopt a cost model or a revaluation model. Now, further in the cost model, as everyone's aware, you have an annual amortization and an impairment charge. That's for the definite life asset. So if your assets have a definite life, you will have an annual amortization and an impairment. But if your assets do not have a definite life or an indefinite life, then you don't amortize them, and you have to do an annual impairment. If you adopt cost model, cryptos, in my view, would be an indefinite life because there is no defined useful life for a crypto. So it should be in the indefinite life bucket, where you will not amortize it, but you will test it for impairment every reporting date. The second model is the revaluation model, where again, you will need to do a fair valuation. Now, the difference between this and the inventory model is that any fair valuation gains and losses under the FRS 38 model do not go to your P&L. They instead go to what we call as an other comprehensive income, and then are presented in your reserves. So there will be a separate category of reserves in your statement of changes in equity, which you can call as the crypto fair valuation reserve, or a crypto reserve, or you can call it anything. Excuse me. And that reserve essentially will stay in the statement of changes in equity till the time you sell these assets. And it's only at the point of sale that these will be reclassified to P&L. Essentially, what this means is any gains and losses gets deferred in the reserves and are recognized in P&L as a realized gain or loss at the time of sale. So again, the benefit is that it insulates your P&L from the volatility. The drawback obviously is the flip side of this, that you can't capitalize on the gains that you might have earned, unrealized gains that you might have earned during the holding period. Now, as I said, this FRS 38 model is a bit counterintuitive because people tend to think of Bitcoins like financial instruments. But the real thing is that, Bitcoins or cryptocurrencies are not financial instruments because there is no contractual arrangement. It's more like, holding a commodity, gold. If you buy gold, you actually buy gold, in the physical form. If you buy it, there is no contractual arrangement with anyone. You hold the physical commodity, the value goes up or down, the gain or loss accrues to you. So it is something similar. Obviously, gold is not an intangible because it has a tangible presence. And that's why for cryptos, we apply the FRS 38 intangible assets accounting standard. Accounting for other digital tokens. So far, what we've considered was the digital tokens, which are for payment purposes, cryptocurrencies. Now, as David mentioned earlier, there are other types like utility tokens, security tokens, and hybrid tokens. So in a utility token, again, the idea is that you get a token, and you invest in a token, and in return you get certain goods and services. So when you're holding such an asset, it can again potentially go into you'll have to go through the same thought process of whether it could be an inventory, whether it can be an FRS 38 item, but there will be an additional angle to it, and that is if it doesn't meet the definition of inventory, it doesn't meet the definition of FRS 38 intangibles, then how do you account for it? So in those scenarios, you'll account it like a normal prepayment, something like a prepaid insurance, where you pay the insurance company upfront and they give you services over 1 year, 2 years, whatever that term may be. Similarly, for utility tokens, the other person has to provide you certain services. So you will treat it similarly if it doesn't meet the definition of intangible or inventory or the guidance in the inventory standard. Security tokens most likely will meet the FRS 109 criteria because these are contractual. However, having said that, the white papers that you typically see, you should consider whether these are legally enforceable in your respective jurisdictions, because that kind of forms the real basis. So if a contract is not legally enforceable, then it's not a contract from an FRS 109 purposes. So you need to look at the legal enforceability. And within this security tokens, you also have a subclass which I can call as an asset-backed tokens, wherein the tokens do not provide you rights and obligations over a certain company through equity or debt, but may provide you rights over a certain asset, like inventory, commodities, real estate. Something like a REIT. An entire REIT can be structured through tokens. So again, the accounting aspect, you will have to consider what you're getting, whether you're getting, whether it's an investment in a security or whether it's an investment in an asset. And only in those limited circumstances, where there is a direct correlation between the token and the rights to an asset, then, you may consider something like an investment property. But again, you need to really look at what the commercial is. So if you have a real estate investment REIT kind of a model wherein you have rights to the cash flows from the asset, then it's again a financial instrument. So I know there's a thin line, but you'll need to kind of analyze it in close detail to see where you land up. And hybrid tokens could have more than one feature. So it could have services, it could have financial commitments. So in those cases, we'll have to kind of segregate the two and account for the utility aspect separately from the financial aspect, so that there's a concept of unbundling that will happen for the hybrid token. So again, coming back to utility tokens, this flowchart kind of shows us what the considerations are. So if you look at the first leg, held for trading, it's identical to the payment token. If you trade in the utility tokens you have invested, there's an active market, and you essentially capitalize or monetize gains from trading, then you can apply the FRS 2 fair value model. For other purposes, you first have to assess whether it meets the definition of an intangible. If it meets the definition of an intangible, then you apply either evaluation model or cost model. This is an accounting policy choice, so you can opt for either one. It's just that once you apply the evaluation model, you can't go to the cost model, while the other way is possible. You can choose cost and move to revaluation at any time, but moving from revaluation to cost is prohibited. And if it doesn't meet the definition of an intangible, then it is a prepayment. It's an advance payment for goods and services, wherein you would just do an amortization of the amount that you have invested in the utility token over the expected period of services. Now, for security tokens, we would generally apply the FRS 109. I assume that most of these would meet the contractual guidance and are legally enforceable. So then you really need to look at what are the rights and obligations do you have. So whether it is equity classified or whether it is debt classified. And the way we look at it, the way we determine the classification is by looking at how the issuer would consider it. If it's an obligation for an issuer, then it's debt classified. It's obligation for issuer when they either have to pay you a regular return in forms of a coupon and a redemption after a certain point in time. It's equity classified when they don't have an obligation to pay you anything. It's more like shares that if they earn something, they will declare dividends or something akin to dividends. So using that logic, you would say, okay, it's either an equity investment or a debt investment. If it's an equity investment, then you have two choices. It's essentially you can choose to carry it at fair value through P&L, where any fair value gains and losses are recognized in the P&L. Alternatively, if it's not held for trading, then you can choose for fair value through OCI. Again, the key thing is if it's not held for trading, anything which is held for trading is always the fair value is always rooted through the P&L. Now, the standard doesn't define what is trading and what is not trading. So there is a bit of a judgment that will be applied over here and will really be dependent upon your business model, which would involve assessing things like the value of trades, and the frequency of your trades. So the higher the value, the greater the frequency. Chances are you are in a trading model. When equity classified investments are fair value through OCI, then any fair value gains and losses do not go to the profit or loss. They instead go to OCI. But unlike the revaluation model for intangible, these gains and losses can never come back to P&L. They'll always remain in OCI, and they'll always be in the reserves. You can't get it back to P&L even when you dispose or sell the investment or token. Coming to the debt classified, you have two categories: fair value and amortized cost. So there are detailed rules to determine what type of investments would go to fair value and what type of investments would go to amortized cost. And generally speaking, investments which have a simple interest, as in which only pay you a compound interest over its tenure and a redemption either during the tenure or at the end of the tenure, and are held in a business model for collecting all the cash flows, would go into amortized cost. So cryptos, you'll have to really look at carefully what your underlying return is. If the return is something other than payment of principal and interest, then you cannot apply the amortized cost model and you'll go to the fair value model. Again, there are two accounting possibilities where it's fair value through profit or loss or fair value through OCI, where we'll need to look at your business model or the intention. Business model of collecting all the cash flows would mean amortized cost, but the business model of collecting and selling, that you collect certain coupon payments but you also sell, would mean profit and fair value through OCI. And if you're in a completely trading mode for a debt classified investment, everything would be through fair value through P&L. So a lot of things or a lot of criteria to consider when you're evaluating an instrument under FRS 109. It's one of the more complex standards in SFRS and requires a lot of assessment before you can button down on an appropriate accounting treatment. So I'll quickly give you an example of each of the types. So utility token. So there is this coin called Filecoins, and there was a ICO for this, wherein through sale of the tokens, the project team raised funds to develop a system, and in return, they granted the investors an access to the decentralized cloud storage platform. Now, what these guys did was they raised a couple of $1 million, and instead of paying back in forms of coupons or redemption, they said you will have access to our cloud storage platform, which we are developing over a specified tenure. So this is an example of a utility token wherein I'm not paying anything in return, but what I'm doing is I'm providing you goods and services. So if I'm holding such an investment, I would have three options. It could either be commodity which I'm trading in. It could either be an intangible, or it can be a prepayment. Now, if I kind of change this example a little bit and say that it not only in this example, the project team did not provide these services, but they provide the holder a right to receive cash based on the platform's future profit or net residual interest or a fixed periodic payment. then what I'm saying is that it now takes a color of a financial transaction, because I'm not providing them services. Instead, I'm providing them return, which might be discretionary, non-discretionary, fixed, variable. Now, depending upon the nature, we'll have to evaluate whether there's an obligation or whether there's no obligation. It could be an equity or debt type investment. And as we discussed in the previous slide, it can either go through a fair value route, or it can either go through a cost route, depending upon the nature of the underlying instrument. So it requires the assessment which we discussed on the previous slide. The hybrid token essentially would sort of combine the features of a utility and security. So let's, continuing with this example, what it would do is it would add rights to receive certain cash flows along with the storage platform. So now I'm kind of committing two things. I'm saying to my investors that not only I'll give you access to the product that I develop, but I'll also pay you a fixed coupon payment or a variable coupon payment every month. Now, then there is a financial and a non-financial angle to it, or elements to it, which would require bifurcation. So we'll need to, so let's say if you invest 100,000 in this coin, then you'll need to split it into two components, the non-financial and the financial. For the non-financial, you'll apply the utility token flowchart, and for the financial, you'll apply the security token flowchart to determine what the appropriate accounting treatment is. So as you can see, this depending upon the complexity of the token, the accounting can also become quite complicated. Now, so far what we have discussed is all from the holder's perspective. I think this slide focuses more on the issuers. What happens when you do an ICO or by whatever name, but essentially what happens when you do a fundraise. So the first question would be, does the token meet definition of a financial liability? So in order to determine that, the key test is whether there is an obligation for us to pay anything, and whether we can defer that obligation indefinitely. So if we kind of think about a simple ordinary shares, in an ordinary shares, the company doesn't have an obligation to pay. They don't have an obligation to declare dividend. They don't have an obligation to redeem. Dividend declaration or any buyback is at company's own will. Now you compare it to a debt or a loan where the borrower has no ability to defer the payment. If the lender asks for interest, the borrower has to pay. If the lender asks for redemption, the borrower has to pay. So, that's the basic principle that defines how you distinguish equity from liability. So if in our token, we have, taken on certain obligations to pay cash or cash equivalents, or or you need to essentially redeem it after a point in time, then you would apply FRS 109. So it is a liability. You will apply FRS 109 to this transaction. If it's equity, the second question is, does the token meet the definition of equity? Then you go and apply FRS 32. So this is really easy. Equity is always at a historical cost. So you don't, whatever funds you raise, minus the cost that you might have incurred for raising those funds, stays in your balance sheet as it is forever. You don't have to do anything. Whereas for a liability, it can be quite complex depending upon your underlying nature of the transaction. It can again be either at cost or it can be at fair value. The third question is a token a prepayment for goods and services? So this is more for the utility tokens. So if it is a prepayment, then we apply FRS 115, because I've raised funds, I've taken funds from people, and I've promised to deliver them goods and services. So then you would apply the FRS 115 5-step model and see how we can recognize this revenue, whether over a period of time or whether at a point in time. And again, like FRS 109, an important point to note is that there should be a legally enforceable contract for you to apply 115, because 115 applies to revenue from contracts with customers. So if there's no contract, there will be no revenue till the point that amount becomes non-refundable. Essentially, you're not required to pay it back. So you'll have to consider the certain legal positions as well. And also, are there any performance obligations? Have I really promised anything, whether it's fixed or variable? Again, and it can have a huge impact on your revenue recognition, because it could vary from something being recognized upfront to a complete deferral of your revenue till the point your obligation under the revenue contract is fulfilled. So there can be host of possibilities. And one more criteria of issuing shares could be that you're using it as an incentive to reward the employees. So if that's the case, then you apply FRS 102. What this standard requires you to do is just to typically fair value it on day one, and then recognize that value of tokens that you have issued to your employees over the period of employee service. So it's like any other ESOP or RSU or share-based payments that you may have seen. So you'll apply similar principles even to the token that are issued to employees. So with this, we've covered the accounting piece, and I'll pass it over to David to take up the tax piece. David, over to you.
Thank you, Chetah, for that. Oops, sorry. And one, just before I do start, ladies and gentlemen, one thing I forgot to do at the beginning was to direct you to the Q&A tab. If you have any questions, if you could stick them on there, rather than on the general chat tab where it gets lost in space amongst all the other chatting that might be going on. And then, as I say, that isolates the questions so we can deal with them at the end of the process. So the tax piece, what are we going to be looking at? Well, you may or may not know that there were a couple of IRAS pronouncements on the approach, both on the income tax side and the GST side. And we'll be taking a look in the context of the generalities of Singapore tax law, how those shape up. On the income tax side, we'll be looking at the influence of accounting treatment. As I mentioned, it was important to get Chetah's piece sorted out first, because that forms the basis of how we then approach the tax. We'll be looking at taxation of transactions, some of the specific transactions that both Chetah has talked about and I mentioned in the what you can do with a crypto slide. And then we'll be taking a look at crypto funds, which are obviously things that are close to, I know, a number of the members in the audience heart. And we will just be taking a brief look at some of the issues that they're facing in particularly the Singapore market. On the GST side, we'll be looking at the classification of the token and the question of whether there is a supply, or what the liability, the GST liability, is on that supply. And I cannot seem to move my screen, so I will re-request remote control. There we go. So the two pronouncements I mentioned, income tax, e-tax guide dated 17 April 2020, so relatively fresh. And just preceding that in November 2019, the GST guide on the GST implications. The difference is that there is no specific law around the treatment of digital currencies, digital tokens in the income tax law. However, there is some new legislation with effect from 1 January 2020 that has crept into the GST section, and Jeremy will be talking about that later on. And again, going back to the definitions, nothing surprising coming out of the two sets of e-tax guides, whereby payment token, utility token, security token are pretty much as we described them earlier. The difference on the GST side is that GST only cares about payment tokens, and all the other tokens get swept up effectively under the same heading. So Jeremy's going to be dealing with that. I'll be looking at the piece on the left-hand side, which is the income tax. So, as I mentioned, generally, tax will take accounting as the starting point, but the accounting treatment isn't necessarily where it ends. And the accounting treatment can be persuasive as to how things should be treated for tax, but not definitive in its own right. Having said that, there is certain specific legislation in Singapore, such as sections 34A, 34AA in the Income Tax Act, which say you must follow the accounting treatment, and we'll be taking a look at that later on. Apart from that, tax basically does its own thing. But again, having said that, and we'll look at FRS 115, which Chetah has already mentioned, there is a suggestion that we should follow the accounting treatment, but we'll come on to that in a bit of detail in a minute. So going back over the pieces, accounting effectively treats cryptos, I use that generically, as either intangible property, if an investment, inventory, if used for trading, a financial instrument, and of course, the one I forgot off the bottom of the slide there, as a prepayment for goods and services in certain situations. So as mentioned, nothing in the law specifically deals with them, so it's back to basics, which is exactly what the IRAS believe as well. Because of course it has to be if there's no specific legislation. And so where do we start in a Singapore context? First of all, we've got to look at the question of, is the transaction on revenue account, i.e. it represents income, or is it on capital account? The difference being that Singapore doesn't tax transactions that are capital in nature, but it taxes things of an income nature. If you determine that your transaction is on capital account, then it's good night nurse, think no more, it's all tax-free. And if it's an outgoing, it's not tax deductible either. So it's only if you determine that the basic transaction that you're looking at is income, you need to then look at the other features which will determine its taxability. And that is the source of the income. Is it sourced in Singapore? Is it therefore exposed to Singapore tax liability? The timing of the recognition of that income, is it now spread out or deferred to a later period? And what is the value of that transaction for tax purposes? What should we be looking at? So as I mentioned, Singapore doesn't have a capital tax regime, capital gains tax regime, which means tax-free capital. Other countries, of course, the distinction may be non-existent because they treat capital gains as income anyway. In other jurisdictions, it may mean looking at some specific laws and some different tax rates as well. But in Singapore, what we tend to use to determine whether a trade is in play and therefore whether the transactions are on revenue account is the badges of trade, which was something that was churned out in the 1950s in the UK and then supplemented by case law subsequently. And really what they're trying to get at is, were you intending to make a quick buck out of this transaction? And that is the basic assertion. No, I wasn't trying to make a quick buck, therefore it was capital. But the rest of the badges, or the rest of the indicia, if you like, are really there to stress test that basic assertion, because they say, well, you told us that this was your intention, but actually looking at the way you've gone about things, we don't believe you anymore. So the whole thing about the badges of trade is effectively disproving that general proposition that you've made, that this is a capital transaction because it's long-term investment, effectively. And then once we've determined that this is income, for it to be taxable in Singapore, it's either got to be sourced in Singapore, or if it's not sourced here, then remitted into Singapore. But in determining source, what the IRAS specifically say in the circular is that they will consider the whole operation of the taxpayer's trade or business and where those activities are performed. If the bulk of the business operations are performed in Singapore, then income derived from such activities would likely be regarded as sourced. So you can see it's not a bright line rule. It's something that needs to be looked at holistically. What is going on? What's generating the income? And where is that income being generated? And, you know, just a sort of international tax 101, it doesn't matter where you put the legal entities. In determining where there is a source of income, you simply look at the people that are involved in these transactions and what they are doing to effect the transactions. So throw away the boxes, throw away the legal entities, tell me where the people are. And it's all essentially about people. And one of the key things in all of this is where the authority to conclude sales contracts vests, because that is the thing that clenches it. Everything up till then is preparatory for that, and everything after it is recording it, dealing with it, executing it. So where the authority to conclude the contract is concerned is very important in determining source in Singapore. And then there's a timing of recognition of income under established case law over the years. Essentially, income is taxable for tax purposes, irrespective of what the accounting treatment might be when it has come home or is realized. And that means you don't need to do anything else to earn it. You know how much it is, and you're never going to need to give it back. It's all yours, essentially. And that is relevant, as we'll see later on, to the treatment of proceeds from the issue of ICOs or ICO issues. In a Singapore context specifically, again, all of those have to apply for it to be potentially taxable. But if it's sourced outside of Singapore, it only becomes taxable when it is remitted into Singapore from overseas. These principles are often at odds with accounting principles, which are increasingly heading towards substance over form, which can allow you to anticipate income or spread income or do different things with income, depending on your circumstances. And the case in point specifically is FRS 115, which Chetah went through with you a minute ago, where the Inland Revenue have produced an e-tax guide about it. And basically they have said, and again, this isn't in the law, this is just the interpretation of the Inland Revenue, that you should follow FRS 115 treatment unless you've got a really clear and obvious contradiction with established case law or legislation. Now that actually doesn't tell us very much, because if you look at established case law, it says it's got to be realized before you account for it. So slightly inconclusive as to where the FRS 115 e-tax guide actually leaves us, but we'll come back to that later. And then the valuation of transactions. Quite easy if one side of the transaction is cash, because that's, that is cash. That's the reference point of any of this at the end of the day. But the question is, what if it's an exchange of digital tokens? And what if I use digital tokens to pay something or to pay for something? Underpinning all of this in any event is that transactions between related parties should take place at market value anyway, irrespective of how they're treated for accounting purposes. So those are the sort of, the building blocks around which we will now try and attack the treatment for the different types of tokens: of payment token, utility token, and security token. But it's still the basic principles that bind them. You've got to go through those, establish what they are before you know where you're going. And so the first one is if you are trading in digital currencies, and really this is digital currencies, digital tokens of any description. They will be taxed at the taxpayer's marginal rate if that trade is carried on in Singapore, or if it's carried on overseas, potentially at his marginal rate when he remits those profits into Singapore. But in order to determine the timing of the recognition of the income from that trade or business, we need to look at how the token is characterized. And the two main categories here, inventory, as Chetah spoke about, i.e. these are trading assets, but they are sitting on your balance sheet at the moment because you haven't sold them. Well, the IRAS view is that because the inventory has not been realized, then the fair value movements that typically will be the accounting outcome are effectively ignored for tax because they are not realized. And so you would only be recording the profit on your inventory when you actually come to sell it. Tokens that are considered financial instruments, which then will be accounted for under FRS 109, will likely also be dealt with in accordance with Section 34A, that is fair value through profit and loss. If those fair value fluctuations are going through P&L on a mark-to-market basis, you will be taxed on those movements, irrespective of whether you've actually sold the asset or not. If they go through fair value through other comprehensive income, then effectively that sits on your reserves until derecognition, i.e. until the asset is sold, and then you sweep it all up and deal with it in the P&L at that point. So ultimately not terribly different between the treatment as inventory and the treatment as a financial instrument, although Chetah will tell you FRS 109 is much, much more complex than that. And then if you're trading in payment tokens and utility tokens, then typically they would be regarded as inventory because they're not financial instruments. However, security tokens may be financial instruments, and therefore you have to deal with them accordingly. Where you've got a hybrid, again, as Chetah suggested, you've got to disassemble the pieces and look at the component parts to understand really what the asset is. As I mentioned, utility tokens generally can't be financial instruments because you're exchanging the tokens for goods and services potentially. That's the underlying in there, not for cash or other financial instruments. Capital and revenue question, is it inventory, et cetera, remain the same for utility tokens. However, if they're used to purchase the goods or services offered by the issuer, they are effectively regarded as a prepayment. And a prepayment, again, is something that sits on your balance sheet and for tax doesn't have effect until such time as you cash it in and take the goods or the services, in which case you credit prepayment, either debit the asset you've acquired or debit the expense if it's a service, et cetera. We're going to look at the tax treatment of the token for the issuer, of a utility token, later for an issuer. And then a quick question: a change a change of mind. What if I've got something sitting on my balance sheet which has been classified as inventory, but I decide now I'm not going to sell it and I park it in intangible property or something else? Then, according to generally accepted case law, that may constitute a deemed disposal of that trading inventory at market value at that point. So something to watch out for, how you classify these things. And that may be something as simple as changing the accounting classification from, again, from inventory to intangible property. Security tokens, as I mentioned, quite likely to be financial instruments, and to keep it simple, would be treated as either a debt or equity instrument. If you are the owner of them and are wondering whether they should be treated as inventory or as an investment, then you've got the same capital versus revenue considerations. Again, change your mind. You may be staring at a market value taxation at that point as if it was a deemed disposal. The tax treatment for the issuer of a security token should be largely the same as if they were issuing equity or a debt, which means that it should be on capital account. Interestingly, but not specifically in relation to this, in 2019, IRAS issued their updated e-tax guide on the income tax treatment of hybrid instruments, which helps you determine, for tax purposes, where your security token should sit in terms of whether it's a debt instrument or an equity instrument. And following on from that, any payouts from that instrument will either be treated as interest or dividends, as the case may be. Specifics for the issuers, really this goes back to the good old ICO. And the real question around this is whether proceeds from the issue of payment tokens, which would be rare events, I can imagine, would be taxable. Well, the revenue view is, to the extent they exist in the real world, the proceeds would almost invariably be regarded as income and taxable up front. Where we're talking about utility tokens, it becomes a bit more fluffy because that may depend upon what is on offer. If it gives any rights in or over the issuer, then it may slant towards a security token with all the regulatory ramifications that all has, which would then make it capital. However, if it's in return for goods and services, plain vanilla, the view is that this would be regarded as deferred revenue. However, Chetah will have mentioned that you need contracts and you need performance obligations in order for FRS 115 to be relevant. And this deferred revenue concept largely ignores the fact that many ICOs, really, if you look at them, have no obvious contractual performance obligations or any obligation to give the money back if the thing goes belly up. And so those contractual features would have to be looked for before we could conclude that the issue of the proceeds from the issue would be taxable upfront, spread or not. So the problem is that if the proceeds from the issue are not deferred, then they will be taxable upfront. And that gives us a problem because typically with an ICO, the funds come in and then they are spent. And of course, if they're spent in a subsequent accounting period, they cannot be carried back and matched with the income, which might have been taxable in period one. So there could be significant mismatch and obviously significant additional tax complications in that rather unfortunate situation. If the ICO fails, then the question of whether the proceeds are taxable depends on the refund obligations. As I said, in many cases, there were no or are no obvious refund obligations. And so the revenue can run around trying to tax the founders on their newfound wealth. But they may be lying on a beach in South America, and getting hold of them may prove difficult. ICO failures, of course, don't just mean people running off with the money. They also mean the fact that the project just didn't work and came to nothing, so all the money was spent. And taxation of founders' tokens depends on whether they're given as rewards for services, in which case they would likely be taxable as service fee income or employment income in their hands. However, if it's just replacing previous funding against rights over the issuer, that's largely looking to be treated as capital. So looking at taxation of miners, the profit from sale, according to the circular, is that whether they're taxable or not depends on the intention to profit. Now, I can't imagine many people actually mining for a hobby, but that seems to be a proposition that is put forward. However, in the context of a company, if you set up a company around a mining activity, there's a presumption you've done that because you're trying to make money out of it. Individuals are presumed to be carrying on a hobby unless they habitually and systematically do it. I'll probably leave that slide where it is, and for you to puzzle out whether there are people around who do this for fun. And then there's the airdrop and forks. Airdrop is a free distribution for really marketing purposes. If it's really free and there's no strings attached, then no tax consequences for the droppee. And if it's the dropper, potentially it could be tax deductible if he is giving away an asset in the pursuit of his marketing activities. Forking involves the splitting Bitcoin to Bitcoin Cash, etc., etc. That involves no realized accretion to wealth because you've got two of them, but you're still not any better off at the point of forking. So the tax consequences would only come into play when the tokens are actually disposed of, as with the share split or other form of capital reduction. The question arises, what's the cost base? Say I get my Bitcoin Cash, I hold on to my Bitcoin, but I sell the Bitcoin Cash further down the track. What is the cost that I'm deemed to have paid for that Bitcoin Cash? And the only sensible conclusion I could come to is that the cost base should be based on the comparative market values at the time of the split, referenced back to the original cost of the original Bitcoin in that situation. And then finally, other situations, funds. We get a lot of interest in people wanting to set up funds, exploring how that could work in Singapore, et cetera, et cetera. Unfortunately, at the moment, cryptocurrencies, digital tokens do not fit into any of the definitions of designated investments, which would give rise to income that is exempt under Singapore's fund management tax incentive regime. They sit outside it. And so therefore, for the moment, if you are trading in cryptos in Singapore, then you are exposed to tax in Singapore if those trading activities are carried on in Singapore. And bear in mind that you may think you're not trading, but if you apply the badges of trade that we talked about earlier on, the Inland Revenue may take a different view. And typically, if you're in a fund environment, the presumption is that you are effectively trading. You're in this to make money, and therefore you've already got your back against the wall in a trading environment. Our contention is that actually payment tokens are currency in substance, because they can be exchanged for other currencies. They can be exchanged for goods and services. They're accepted in circulation. They're not Singapore dollars, so they must be foreign currency, and therefore they fall under the protection of foreign exchange transactions, which are designated investments for the incentive purposes. We don't believe we're going to get very far, or we haven't got very far with that argument at the moment. The barricades seem to have come up, but we're ever hopeful that we can press that forward, because I think ultimately it's a great opportunity for Singapore to capture the fund managers who are looking to getting involved in this industry. For the time being, it appears the US dominates that space. Well, perhaps Singapore has got an opportunity to knock it off its perch. And so I might have missed out my last slide, sorry. Yeah, so this is just the conclusion. When you're looking at transactions in cryptos, look at the basics. Is it capital? Is it revenue? Capital, shut up shop, don't worry. If not, look at the source, timing of recognition, and the value. And I have to say, looking at the IRAS circular on the whole area, it's logical and reasonable, and I think that it is a pattern that could be followed in other countries going forward, who are similarly in a situation of not having put legislation in specifically around these sorts of transactions. So with that, I will hand over now to Jeremy, who will take you through the goods and services tax.
Thank you very much, David. Good morning, everyone. And for those that haven't heard me present before, I do have a stammer, so if I do stutter, please bear with me. So without further ado, I'm going to cover the goods and services tax implications surrounding cryptocurrencies. GST is in a slightly different position to that of the corporate tax, in the sense that there is actually the Ministry of Finance and IRAS did actually propose and implement some new legislation with effect from the 1st of January 2020. And what that legislation effectively does is it provides us a classification for how certain types of tokens will be treated from a GST perspective. So what the GST legislation did is it effectively looked at what a digital payment token was, and it compared it to the other forms of digital tokens. And effectively, the position was concluded that a digital payment token should effectively be treated akin to a fiat currency. However, it hasn't gone as far to say that from a regulatory perspective. So within the legislation, the term digital payment token is actually defined. And as you can see from my slide, it has to be expressed as a unit. It needs to be designed to be fungible. It's not denominated or pegged to any other fiat currency, and it can be stored, transferred, and traded electronically, and is ultimately intended to be used akin to a currency that's generally accepted by the public. However, there are obviously some exclusions to that, which are also there as well. So from a GST perspective, I'm now going to look at the treatment of digital payment tokens specifically in a bit more detail. And as I mentioned, the change in legislation was effective the 1st of January. So prior to the 1st of January, all crypto assets, whether they were digital payment tokens or other forms of tokens, were effectively treated as a taxable supply of services and were in effect taxed as if they were a barter transaction. However, from the 1st of January 2020, there's actually two potential perspectives in relation to payment tokens. The first one is where the digital payment token, so for example, the Bitcoin, is actually used as a form of payment. And in such cases, there's actually no supply for GST, just like if you were to pay for some goods or services using Singapore dollars, the payment of the Singapore dollars would not create a supply within its own right. The second perspective is when you're not using the digital payment token as a form of payment, or when you're exchanging it for another form of payment or for a fiat currency. So similar to where at the moment, if you were to exchange Singapore dollars for US dollars, any profit or loss realized on that exchange would actually be treated as an exempt supply for GST purposes. And the second one, which is a little more unique, is where you actually derive some interest when you loan a digital payment token to another party. So just by way of an example, we have company A and company B, and what we've got is that company B is supplying some goods to company A, and company A has paid for those goods using Bitcoin. So as I mentioned on the previous slide, the use of a digital payment token as a form of payment does not create a supply for GST. So there's no GST supply for company A. However, there obviously remains a supply of goods by company B, and they will need to account for the GST on the value of the goods which have been supplied to company A. One of the key things to note here is obviously the question around the valuation of the supply. So ordinarily, the value of the supply would obviously be determined by the value of cash paid by company A to company B. However, in this situation, the payment is in the form of a digital payment token. And so we would actually have to look at what the market value of the goods being provided by company B to company A is for the value of the supply to be declared in the GST return of company B. And then the second one is we have an example where company A and company B are exchanging different forms of digital payment tokens. So as I mentioned, under the new legislation, the net profit or loss realized on the exchange of a digital payment token for another digital payment token or for a fiat currency such as Singapore dollars would be treated as an exempt supply for GST purposes. So in this case, both company B and company A would realize a net gain or loss on the transfer of the funds, and therefore both would have a GST reporting obligation within box 3 of their GST return. And again, we'd need to consider what the value of the crypto asset or the fiat currency are within that transaction to work out the net profit or loss realized for GST reporting purposes. And then so with the new rules from 1st of January, we have digital payment tokens that can now effectively create an exempt supply for GST purposes. So we would therefore need to consider, well, whether as a result of these exempt supplies that the company now becomes partially exempt from a GST perspective, and therefore may not be entitled to reclaim all of the GST that incurs on its costs. And then further to that, if a business is partially exempt from GST purposes, they would also need to have to consider the impact of the new reverse charge provisions, which also came into effect from the 1st of January 2020. So now we've covered the digital payment tokens, I'm going to look at how the GST position would be for the other forms of tokens, and effectively we are in the same position that we were prior to the 1st of January. So that the default position would be that the supply of the token would be classified as a supply of taxable services from a GST perspective. So I've got an example here on the left whereby company A is giving another form of token to company B in exchange for the goods being provided by company B to company A. So in this situation, we've actually got a position where both companies are treated as making a supply for GST purposes. Company A is treated as making a supply of taxable services in the form of the token, and therefore has a GST reporting obligation. And likewise, company B also has a GST reporting obligation on the basis is making a taxable supply of goods. The same considerations will apply in relation to the valuation of the transaction, where the goods are not paid for in the form of cash. We would need to consider the open market value for the purposes of the GST reporting, and that would apply for company A as well as for company B. And then just moving quickly on to the GST implication for minors. It ultimately goes back to the fundamental principles, and that is whether there is a close nexus between the service being provided and the consideration that is received or earned for the service that has been provided. In the vast majority of cases, when someone is mining a token, they don't actually know who is the person that is giving them the token in exchange. In other words, there's generally only one side to the transaction, and therefore, because there are not two parties providing consideration for the transaction, it's not actually treated as a supply for GST purposes, and that therefore would not be reportable on the GST return for the miner. However, there are often situations where miners or people who are building on the blockchain actually get paid a commission or a transaction fee. In this case, there is actually consideration provided by both parties, and therefore the commission would actually be treated as a supply for GST purposes and would be subject to GST. We would obviously need to consider whether the commission is earned from an overseas person and therefore may actually qualify as an international service and benefit from zero rating. And then quickly, just to touch on the GST treatment for the intermediaries. Again, there's no special provisions for this within the legislation. It ultimately goes back to the fundamental principles, which are the standard considerations, whether the intermediary is acting as principal or is acting as an agent. In the case where they're acting as an agent, it will only be the value of the commission that will be treated as a taxable supply for the agent, and therefore they would only need to report their the value of the commission on their GST return. Whereas when they're acting as principal, they're taking on all the liability for the underlying tokens, and they would then subsequently dispose of those liabilities and conditions. Then they would actually be treated as making a supply for the full value of the token and would need to report the full value on their GST returns. And I think with that, that brings me to the end of my slide, and I'm going to hand back over to David to go through the Q&A and some final closing remarks.
Okay, thank you, Jeremy, for that, and thank you, Chetah. Yeah, we got a few interesting questions. Now we're slightly up against time. We got 5 minutes against our schedule, but let's see how it goes. A couple of questions in. Let me see where we start. Question, how do we value the tokens for tax purposes based on the accounting value? I sort of thought I'd answered that, but then thinking back, the slide may have slipped past. Essentially, the value that you would take, say, if you're exchanging tokens, would be the market value of those tokens at the time of the transaction. And typically you'd get that from an exchange, but in situations where you don't have a ready-made exchange, you've got to come to some other sort of means of valuing the thing. Again, if you're exchanging Bitcoin for a loaf of bread, it's probably easier to find out the value of Bitcoin than to go and, you know, get a bread exchange valuation. So, you know, but the basic principle is it's a barter transaction. You've got to try and determine what that market value is at the time of the transaction. Question, how do you classify the token as debt or equity investment? I think, as I mentioned, there is a circular on this particular topic, not aimed or not brought out specifically for cryptos, but is very helpful in a general sense for determining whether a transaction is an issue of debt or equity. And this argument usually revolves around things like preference shares, because, you know, we call them shares, but then if you look at some of the features, they may have debt characteristics, which then points it in a different direction, such that your coupons are no longer dividends, they become interest. And there's a whole laundry list in that circular, which basically takes you through what those things are that you need to think about. I won't go through that at the moment, but I'd encourage you to take a look at it. It's on the IRAS website. And then if this is a debt token, an interest is paid to a non-resident, presumably Singapore withholding tax has to be complied with. Absolutely correct. It would be likely treated as interest in the normal sense. When and at what value, presumably IRS don't accept tokens. So if you're paying, sorry, is that a question for Jeremy? Because you tried to cut in, no? Somebody's nicked the question. Okay. Okay, sorry, the question has disappeared in front of my eyes, but I think it was around withholding tax, and the answer is that withholding tax, yes, would be payable. It would be payable based on valuation at the time that the payment was made. And if that payment was made in tokens itself, then it would be necessary to determine what the market value of that token is by reference, again, to an exchange or other appropriate means. And we have a GST question here, a GST post 2020, where we use the digital token as a form of payment. Would there be a difference in the value in the token when first bought by the company and when it is used as a form of payment? Would the difference be an exempt supply? There you go.
Yep, of course. So I guess what the new legislation has effectively done is, from a GST perspective, we are now effectively treating digital payment tokens akin to a fiat currency such as Singapore dollars. So the short answer to the question would be that if you do realize a net gain or loss between the acquisition and the disposal in the form of the payment, then that realized gain or loss would be treated as an exempt supply on the GST return, exactly like we would for any gain or loss realized on the use of Singapore dollars or US dollars.
Okay, thank you. And then we have one from Pooja, and this is a very difficult question. How does the tax regulator look at the argument that the transactions are not concluded by direct human intervention, but by the technology platform? Well, that's a question that we sort of wrestle with every day, because yes, these things are becoming more and more automated, and taxpayers are trying to put forward the argument that, well, these transactions happen in the upper ether, therefore they can't be sourced anywhere. I think the revenue take a slightly different view, and what they do is they go back to, if you remember the slide where I talked about them looking at the whole business environment that goes around this. And so what they would probably say is, even though your server that does all these algorithms is sitting in the Cayman Islands, all the people that are running the business, that are maintaining the thing, that are marketing the product, et cetera, if they're all sitting in Singapore, then the finger would get pointed to Singapore. And in fact, a number of years ago, the revenue came out with an e-commerce tax guide around this particular subject. So they said that having a server sitting in a room doesn't attract value. It's the people that are exploiting that thing, maintaining it, that you need to look for. And so, not a very difficult question, but I think there is a direction of travel around that, and that it's looking for the people again.
David, could I just expand on that question then? So so you mentioned that Singapore has obviously taken the position that having a server in a specific country which is doing all the trading does not create a permanent establishment. Are there other countries which actually take a different view, whereas if you have a server within their country, that they actually treat it as creating a permanent establishment?
That is that is a possibility. I think Australia, for example, has this concept of substantial equipment, which in its own right can create a PE. But again, if you look at the definition of PE, it is a place where the business is wholly or partly carried on. So the question would have to be, can a little piece of, or a big piece of equipment sitting in a particular country be regarded as carrying on a business, or is a business only carried on by people? So you've got to have someone operating it to do that. But you're right, there are countries that look at substantial equipment as being the first step in determining whether a PE exists. So it could contrast with Singapore's position on that. And final, last two, I think. For hybrid token, do you recommend obtaining a ruling from IRAS on its characterization? Well, I don't know how to answer that really. First of all, you would go for a ruling in a situation where you don't know the answer, right? So if you've managed to work the answer out for yourself, I would always recommend going forward on that basis. If you're uncertain about it, then yes, you can go and get adjudication effectively from the Inland Revenue. But of course, the answer isn't necessarily always as you hoped. So I always think long and hard before going for a ruling. And if I can find that I have a clear view on what the outcome should be, then I wouldn't go for a ruling. That's maybe a personal thing. And then the final one, just as we wrap up, sorry guys, we're 5 minutes over, but it is heard that Singapore shall have their own digital coin. If that's the case, whether such Singapore digital coin is considered a Singapore other currency, not foreign currency. Ooh. Subsequently, can this consider digital coins are legally accepted by Singapore authorities? Does Singapore have such legal regulations in place? Well, okay, that's slightly outside our purview, but our understanding is that Singapore is certainly working towards that, to issuing its own digital currency, if it hasn't already done so. Whether that makes it Singapore currency or not, I don't know, because the other digital tokens that are pegged to fiat currencies aren't necessarily regarded as those currencies themselves. But if it is supposed to just be a representation of Singapore legal tender, but in a digital form, then I suppose it's Singapore dollars and not foreign currency. If that helps. So I think, guys, that about wraps it up for today. If you've got other questions, you've got our email addresses. Perfectly happy to chat through any stuff, bounce stuff backwards and forwards, but just up to me to say thank you to my co-presenters, Jeremy and Chetah, and have a good Friday. It's nearly Christmas, and keep your Bitcoin for a while. Okay, so bye-bye.